We're in a 20-year series of booms and bubbles. And now we're in the biggest bubble ever. And that bubble is likely to pop. If we get out of this mess with a recession, we're going to be really lucky. And so the Fed cannot continue this hard line on fighting inflation while the government at the same time is running huge deficits and financing it by printing money.
Hello everyone, welcome to SFC Markets and Finance. The Fed just raised its target interest rate by 75 basis points to a level that many have not expected at the beginning of this year. But still, as the inflation remains high, some started to question whether or not the Fed has been doing enough. Are people losing their faith in the Fed? Will it be able to win the trust back? And is it becoming increasingly difficult to achieve a soft landing? Let's welcome David Blair, Vice President at the Center for China and Globalization, to join our discussion. He was Professor of Economics and Chairman of the Economics Department at the Eisenhower School of National Defense University in Washington, D.C. Hello, Mr. Blair. Thank you for joining us. The Fed raised its target interest rate by 75 basis points for the third consecutive time. Does this show that the Fed is determined to fight inflation? How effective have the Fed's rate hikes been in terms of bringing inflation down so far?
It's far from clear that the Fed is determined to fight inflation. That's a very difficult process. We've seen in historical examples of inflation that the only way to get out of an inflation rate as high as we currently have is a severe recession. And the Fed has not shown that it's willing to fight inflation seriously. It's moving in that direction. Kind of hope it does, but I've seen this before, and I've seen attempts by the Fed to fight inflation, and then they lose courage and they step back from doing that. Let me make two quick points. One is that you should be looking at real interest rates, not nominal interest rates. Nominal interest rates are the posted interest rate. Real interest rate is the posted interest rate minus the rate of inflation. So the real interest rate right now is -4 or 5. To even make a step toward fighting inflation, you basically have to go to an interest rate that is higher than the rate of inflation. And we're nowhere near that. Can I take a minute to talk about some history? I think history is very informative. In the 1970s, we were experiencing inflation and stagflation similar, but I don't think quite as bad as we're seeing now. And so we started in the 1960s, the government started pumping money into the economy, using the Fed to pump money they did it both in fiscal policy and monetary policy, which drove up the inflation. They thought they'd get a boom out of it, but they only got a short-term boom. So they would bump money into the economy, and they'd get a move toward a recession, and they would put more money into the economy. And then they would eventually, a year or two later, get something that looks like a slowdown, and then they put more money in the economy. And this continued through the 1970s. And several times in the 1970s, the Fed tried to fight the rising inflation, which at that time was scary 4 or 5%. And then they would back down because they would see a recession started, and they got scared and they would back down. And finally, by 1979, let me give you the exact number here. In 1979, the inflation rate reached 13.3% in the United States. In 1978, it had been 9%. In 1977, it had been 6.7%. So it looks a lot like what's happening now. So, and the federal funds rate, to try to fight it, the Fed had to raise the interest rate to 12%. The federal funds rate, which is the rate that you're citing. And in 1980, the inflation rate was 13%. And the Fed, in the meantime, had raised the federal funds rate to 18%. That's compared to the 14% now. Compared to the 4% now. And that caused a very severe recession. That's way higher than the federal funds rate. What they call the target rate for the Fed is today. And to fight today's inflation, you're going to need something like that. And the Fed has come nowhere close to that. They're sort of at the early stages of what the Fed was doing in 1974, trying to fight inflation a little bit. But I think they're going to get scared. You know, they're going to see an elections come in, they'll back down. I don't think they're going to seriously keep this going. But that's the only way to get out of the recession. It caused a very severe recession in 1980, 81, 82. But fortunately, we had two presidents who had a lot of courage. President Carter, to give him credit, and President Reagan. They both, President Carter probably realized that fighting inflation would cost him the 1980 election. And President Reagan was risking losing the 1984 election. And they had a very strong chairman of the Fed, Paul Volcker. And we don't have people like that today.
So from what you just said, the Fed has not shown enough willingness to fight inflation seriously. But we know that the Fed may still be trying to achieve soft landing, or at least that's what they've been saying. Do you think a recession is inevitable?
We don't have any historical experience of soft landings from current inflation levels. No experience at all. Even the one time in the meantime between the severe inflation in the 1970s and early 80s to today, the one time they fought inflation a little bit and got something like a soft landing was 1990 and 91. The inflation rate had gone up to, I think it was about 6%. And to fight that inflation, to bring it down to 3%, the Fed raised the federal funds rate. And that caused a short recession. But that was from a very mild inflation compared to what we have today. And it was from a Fed. The Fed under Paul Volcker had been very responsible. People believe what Paul Volcker said. And so we don't have a history of that anymore. That's not the situation we're in today. I think a recession is probably the best outcome. It could be a lot worse than that.
The dot plot shows the Fed anticipates more hikes this year and the next, and the key rates could go up to about 4.5%. What do you think of it?
Well, we only have one historical example of fighting inflation at near current levels, and we really don't have any good theory. So it's very hard to predict how it's going to come out. But 4.5% is still negative real rates. It's still way negative real rates. I don't see any chance that it's going to work without causing a recession. There's no previous example of where that happened.
So what impact will it have on the financial markets?
You know, that's the big question. Let me just take a little bit of time to explain where we are today. We had pretty responsible monetary policy after Paul Volcker's great success in the early 1980s, where he brought down the rate of inflation. And then after a severe recession, the most severe since the Great Depression, the economy started to grow in a steady, reliable way. The federal funds rate, the target rate for the Fed, was reliably about 5 or 6% through the 1980s and 1990s. And, you know, we thought we'd solve that problem, and that was wrong. What happened is we had a boom in the United States in the late 1990s that brought in a lot of revenue to the government. So it led to almost a miracle of a balanced U.S. government budget. And that boom ended in March of 2000. There was the NASDAQ collapse. The NASDAQ fell by more than 50%. So, what the Fed and the government should have done was allow the economy to stabilize, but they didn't do that. They used a lot of monetary stimulus. And so from the 1980s and 90s, when we had a sort of a steady federal funds rate of around 5 or 6%, starting in 2000, 2001, we ended up with a federal funds rate, which for most of the period was less than 1%. Highly stimulative monetary policy we've had for 20 years. So what that did is it caused a boom. What very low interest rates do is they cause asset prices to rise, because I can borrow money very cheaply and I can buy stuff with it. And so we had a big housing increase, and we had a lot of people that really couldn't afford the house buying houses, and we had stock increase and everybody was happy. And then it collapsed in 2008. And they did, and this was a terrible collapse. But the way they got out of it was just doing more of the same. I think Alan Greenspan deserves all the blame, basically. Well, I mean, President Bush and other people deserve a lot. Bush 2, not Bush 1, deserve a lot of blame too. But it was basically Alan Greenspan's monetary policy that led to the housing collapse of 2008. But then we had Ben Bernanke and also following up with just more and more stimulus, sort of unprecedented. I was just shocked what they were doing. I've never seen the Fed do anything like this after the 2008 collapse. And they led to another sort of boom, but it wasn't anything real. It was just asset price increase. It was more stock boom, more housing price increases. And now we've had 20 years of a highly stimulative economy with very, interest rates close to zero. And it's caused huge distortions in the economy. I think it's one of the major causes of the rise in inequality in the United States. It's rewarded people that were already rich or people that were politically connected, and it's punished people that were actually producing real goods in the real economy and working class people. Since we've had these low interest rates for 20 years there, and the US government have been assuming that interest rates are going to stay near zero. And so if interest rates really go to 5 or more %, those companies might just fail. I mean, it might look like Bear Stearns and Lehman Brothers collapse, but I mean, there may be many, many hedge funds out there controlling possibly trillions of dollars that have borrowed money at 0% and have based their business model on being able to borrow money at 0%. And if that changes, then they may just collapse. And then what do? I don't know. We would probably just try to double down again, but I don't think the policy of continuing artificial monetary stimulus is going to work going forward. We're in a 20-year series of booms and bubbles, and now we're in the biggest bubble ever, and that bubble is likely to pop. So we get out of this mess with a recession, we're going to be really lucky. It could be a lot worse than that.
In the newly released economic forecast, the Fed expects that the U.S. economy can still achieve positive growth this year and the next, and implies no recession. Do you think that's too optimistic?
The thing to remember, there are lots of economic models out there, and they're pretty good at predicting next year. Nothing changes. Basically, if there are small changes and things going along just sort of on the same trends they're in now, those models are pretty good at predicting it. But none of those models are successful at predicting turning points, ever. All they are is just extrapolations of the present. So if you say, I'm tweaking the present a little bit, they can kind of tell you what's happening. But if there's big risks out there, they're no good at telling you about that. So I think the models the Fed is looking at are probably okay in normal times, but these really are not normal times.
You mentioned a lot of the history, but from where we stand today, things are still kind of different from what we see in the past, right? For instance, the labor market remains tight despite the Fed's attempt to slow the economy in a manageable way.
That's true. We have not seen we had high unemployment, approaching 10% in 1979 and 1980. But the U.S. labor market still has fewer jobs than it had before the pandemic. So a lot of this is just people coming back to work from the pandemic. Part of it is that wages are so bad. I mean, the U.S. median real wage has not gone up at all since 1979. And in the last year, it's fallen 5%, real wage, because wages go up, the inflation rate, 8%, wages go up 3%. That means you've just lost 5% of your wage. So a lot of people are taking two jobs just to get by. And some people have just left the economy, they're relying on Social Security or something as soon as they can. So it's not like there's really a good working class situation. It's just that, it looks good because we're recovering from the pandemic, but it's nothing. We actually had real wage increase the only time in the last 40 years in 2017, 18, and 19, the first 3 years of the Trump administration. And we're nothing like we were in that time in terms of real wages or real employment.
What do you think the Fed should be doing at this point? Or do you think there's only so much that Fed can do for short-term inflation relief that the US needs other approaches to help bring down the inflation?
And everybody knew there were going to be tremendous budget challenges in this decade, in the 2020s, even through the 2030s. But we should have been trying to have a responsible federal budget over the last 20 years, but we didn't. We had governments throwing money at everything. I mean, sort of the last straw was when the Biden administration came in 2021. They created this huge budget bill, which Larry Summers, who was the Secretary of the Treasury under President Clinton and the chief economic advisor to President Obama, said was the most irresponsible fiscal policy he'd seen in his lifetime. And there were people out there saying, well, it's no problem. We're running these huge deficits. We're running a huge debt, but it's okay because people are lending us money at near 0%. So if somebody's going to lend you money at near 0%, you might as well take it and just spend it on whatever you want. That was the view. I mean, there was this ridiculous thing called modern monetary theory, which is neither modern nor a theory, but basically says just print money and finance the government, which is basically what they've been doing. But if interest rates go to 5%, then it doesn't, so essentially paying the interest on the national debt over the last 20 years, because we've had zero interest rates, didn't really cost anything. It didn't cost very much. But if interest rates go to 5%, all of a sudden, the payment of interest on the national debt looks like 5% of GDP. That's another 5% of GDP that has to come from somewhere. And so the US government has to make a decision. Are we going to raise taxes, or are we going to cut spending somewhere to try to balance our budget? Or are we just going to keep printing more money? Well, every indication I see is that they're going to continue printing more money and financing it through, printed money. I mean, it's a little bit more complicated than just printing the money, but that's essentially what's happening. And so the Fed cannot continue this hard line on fighting inflation while the government at the same time is running huge deficits and financing it by printing money. So it's going to take hard political decisions to change anything. And I think it's unwise to expect hard, wise political decisions anytime in the near future. We've had, essentially we had two episodes in the 20th century where the government had to make big changes to try to save the economy. One was, as I just talked about, Presidents Carter and Reagan and Paul Volcker in the 80s. But the other one was the 1930s collapse, where President Roosevelt had to make some really hard decisions and essentially save the economy. But I think that's what's going to be required, something on that level this time. And I don't know whether we have any leadership out there capable of doing that.
What do you think of the public's confidence in the Fed in terms of lowering inflation?
I haven't seen any polls on that. I don't see any reason for them to think they were to be confident. There was a lot by the 1970s. Again, I keep talking about the 1970s, but that's when I graduated from high school and college. I went to graduate school in economics. And that was a big transformative time in the U.S. economy. It's lucky we got out of that mess. They had no confidence in the Fed by the late 1970s. Nobody believed anything would ever change. But Paul Volcker, as chairman of the Fed, came in, and very strong chairman. Even he tried to fight inflation a little bit in 1978, backed down, but then in October of 1979, he had an emergency meeting in the Fed and took very strong actions to try to right the ship. And so after Paul Volcker created a lot of confidence in the Fed, and then people had a lot of confidence in Alan Greenspan, who was the next chairman of the Fed, largely carried over from Paul Volcker and a few little successes he had early in his tenure. But I think that was completely misplaced confidence. He started this boom bust cycle. And then you had Ben Bernanke and Janet Yellen come in at the Fed who were responsible after the 2008 crisis. And they just continue that cycle. Now, that makes sense in the short term. If you're in charge of something and you say, well, I know this is bad policy for the long term, but if I don't do this, I'm going to die, then you just do it. And that's the situation they were really in. But we keep getting addicted to this drug, and the addiction gets worse and worse. And I don't think anybody has the confidence that we know how to get out of it. We don't really have a theory. The problem is in the 1970s and 80s, there was a theory called monetarism that basically the Fed doesn't make any decisions. It just lets money supply go at 3% per year. But since Alan Greenspan, they really haven't been following that theory. They've just been looking at it and saying, well, okay, inflation looks okay, what should we do? Or inflation looks bad, what should we do? But there's not much theory behind it. And when there's no theory, you don't know how it's going to work out. But everybody knows that short-term stimulus causes long-term pain. No, I don't think anybody disagrees with this except the ridiculous modern monetary people. My guess is they're going to go for short-term stimulus and try to put off the long-term pain until they're out of office. That's my guess. But, you hope you come up with some good leadership.
Thank you so much, Ms. Blair, for sharing your views with us today. So the Fed will continue to raise rates. In this process, how will the U.S. economy as well as global markets be impacted? We will be watching that closely. That's all for today's show. See you.